Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. Stocks took a pounding during the week but showed signs of life on Friday. Ross looks at crude, gold, silver, agricultural commodities, and Bitcoin. Author of the book The Money Bubble, John Rubino, comments on how central banks were slow to deal with obvious inflation. He also comments on food shortages, geopolitical conflicts, globalization, and mining stocks. Realtor Steve Saretsky gives us his view on what's going on with what can be Canada's craziest real estate market, Vancouver. Has the steam gone out of the rapid rise in property prices? And can politicians really do anything about the high cost of housing? We'll talk to Ross Clark right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Always good to be with you, Jim.
What an interesting week on the stock markets. There was so much red on my Bloomberg screen, I thought I'd have to throw some Visine on it to clear it up. And apparently that worked because by Friday, a lot of green on those charts. But was it enough to recover all the losses from earlier in the week?
Well, it depends upon where you're looking. In most cases, no, it was not. Some of the percentage gains are pretty big. I mean, NASDAQ got 4% move on the upside, but that's still not enough to offset the loss week. And, I think depending upon the index, you're looking at somewhere between 6 and 8 weeks here of downside pressure. And, I'm continuing to think that, this is, the unwinding of the, innovation group, the ARC stocks, and, the classic here where this growth group that has just led the way for the last few years is still doing its unwinding process. But we got some good capitulation numbers right into Thursday on some of these indices. So we're ready for probably the best bounce, not just on this Friday, but probably have some follow through as we move into next week. And wouldn't be at all surprised that we saw on Friday where the growth stocks are starting to finally show improvement relative to the value stocks. So maybe, as I say, the better part of a couple of weeks here of a bounce. But overall, it's going to take time for this market to find any kind of a decent bottom, and I wouldn't be looking at long-term investments. I'd be looking at short-term opportunities right now.
How is crude doing?
Well, we've got a few items that have shown very good resiliency this last month or two, and crude is right up there on the list. The last correction, so we closed the week off around $110. Very good number there. The pullbacks have been holding around the high 90s, maybe 98 to 100. And at this point, the oil market is actually holding up better than the stocks. The stocks had decent pullbacks to their 20-week moving averages here a couple of weeks ago. They've held well against those support areas, but there's not been a lot of upside action. Oil has moved back into the 110 range. Wouldn't be at all surprised that the oil stocks just sort of grind their way higher rather than have the explosive kind of moves that we saw in the first quarter of the year. The other area where we've seen resiliency is in the agricultural market. If we take a look at corn, wheat, soybeans, they have all held very nicely on corrections in this last couple of weeks. We got some oversold readings, so I think you've got some upside bias there. This whole inflation move and everything is still very, very much like the 1972, 1974 run when we saw soybeans in particular have that big run based upon the anchovy situation down in the Pacific. So at this point, agriculture looks like it's a good one for the upside. In terms of ones that have really been hit the hardest and had some nice capitulation readings, the Bitcoin on Thursday, Friday, we had the first capitulation signals that we've had in months. So that's probably good for maybe a couple of 1,000 points here on the upside. The same type of thing over in silver, and silver's really been underperforming gold quite a bit in the last month or so. But as of Thursday, Friday, that's one that has now become excessive on the downside. And for short-term traders, there's very little doubt, I think, in my mind, that there's a few dollars to be made on a bounce right there.
The U.S. dollar, is it still on a tear?
On a really nice run, but just like a lot of things, becoming excessive. As of Friday, the dollar, we're sitting at about 104 and change on the index. It's been a nice run from 90, but becoming excessive. Looking for support back around the 101 level, and wouldn't be at all surprised that we see a pullback in.
Ross, thank you so much for chatting with us.
Always a pleasure to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, John Rubino, next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is John Rubino, author of several books on the economy, including The Money Bubble. He founded the website dollarcollapse.com. John, welcome back to This Week in Money.
Hey, Jim.
John, what's the real rate of inflation, and could it be peaking?
Well, in the U.S. at least, they lie to us about inflation, and they have for a long time, in order to keep it lower or keep the headline number, the official headline number, lower to maintain the illusion that they're managing the economy in a reasonable way. And even so, we've got something like 8% official headline inflation going right now, and that means it's probably closer to 10 or 12 in real terms. So that's crisis level inflation. I mean, we have to remember that the Fed's target rate is 2%. That's the point at which, under their own rules of engagement, they're supposed to be raising interest rates and tightening monetary policy, and they let it run all the way up to 8% official and much higher than that in reality. So they're in a very bad spot right now, which we'll talk about pretty soon, I think. But as for whether it's peaked, there are reasons to believe that, and there are reasons to expect it to continue to increase going forward. And it's not clear which of those factors is going to win. On the it has peaked side, a lot of stuff has just gone way up, and if oil is, for instance, $100 a barrel, it can stay at $100 a barrel, which is debilitating for people who have to drive long distances to work.
But if it only stays at $100 a barrel, that means inflation is zero going forward. So the rate of depreciation in the dollar will diminish greatly, even though prices are so high that it still hurts people. On the other hand, we've got energy and food shortages that are just now beginning to bite. For instance, diesel fuel is extremely expensive right now, and there are shortages of it, which are hampering the trucking sector in particular, but also the mining sector. Anybody that uses diesel fuel to run their vehicles or to generate electricity or whatever else you do with diesel, they're all hurting big time right now. And that doesn't look like that's going to be fixed anytime soon. There just isn't enough capacity to produce as much diesel as is apparently needed, which means supplies could continue to tighten, prices could continue to go up. Same thing in the food sector. The Russia-Ukraine war made a bad situation even worse because there were already a lot of weather-related disruptions and other kinds of, and COVID-related disruptions that had already spiked food prices and created conditions for shortages going forward. Now, the Russia-Ukraine war has just made that worse. So next year's food prices depend to an extent on what happens in the ag economy this year. In other words, what is planted and what is produced otherwise this year. And it's not looking good. So it could be that food prices and energy prices both continue to rise at a fairly dramatic rate in the coming year, which means inflation could be even higher this time next year than it is this year. And you know what? There is no way to know whether that's the case or whether the fact that consumers are maxing out their credit cards and the economy seems to be slowing down, and that might lead to actual deflation. There's no way to know which of those is going to play out. So all you can say with any kind of certainty is that as far as inflation, stock prices, and to an extent geopolitics goes, volatility and chaos are the two things that are most likely. And you can't tell whether that's going to be volatility to the downside or upside.
Is the Fed finally in an unwinnable situation?
Yes. Now, I've got to preface that by saying I thought they were in an unwinnable situation in 2008, 2009. I didn't think they could recover from that because we were already so deeply indebted that I assumed the financial system would just blow up and then something would have to be rebuilt from the rubble. But they managed by creating insane amounts of new currency and pushing interest rates to absolutely unprecedented low levels, negative in a lot of cases. They were able to buy us another decade of financial speculation and fake growth. But at the cost of a huge increase in debt from already impossible levels in 2006, 2007. So having admitted that I got the prediction wrong last time around, I'll still make the same prediction that this time it's an unwinnable situation for the Fed, because if they raise interest rates, which they, logically need to do in the face of inflation this high, they may be doing it in the face of an already contracting economy, and they might make a brief recession so much worse that it becomes something like a depression. Or if they stop, they recognize that the economies of the world are weakening and they stop raising interest rates, they'll be doing that in the face of double-digit inflation, and they might just, set people off. Everybody's just going to assume that the Fed is never going to be able to control inflation, and everybody starts panic buying everything in sight, and that gives us this huge new burst of price increases. Either one of those is possible, and there are no other choices as far as I can see from the Fed's point of view. So they got to choose one, and just put us through whatever it is they cause by making that choice. But either way, it's going to be ugly, and the fact that it's so hard to predict, and the two possibilities are such diametrically opposed possibilities, that means it's very hard to manage money in this kind of an environment.
I saw Jerome Powell's speech last week, and he said, we can't do anything about supplies. All we can do is control demand. Is that true?
Yeah, the Fed cannot produce more wheat with monetary policy, for instance, or they can't make Russia and Ukraine cut a deal and then start exporting all their agricultural and energy commodities to the world. They can't make those things happen with monetary policy. So they can't affect supply. at least in the short run. Raising interest rates does affect demand. It makes things more expensive. For instance, houses. If you're looking at a kind of an expensive house, but they'll give you a mortgage of 2.5%, maybe that house is affordable. Let that mortgage go up to 5.5%, and all of a sudden, that thing you could barely afford is way, way out of reach. And so that's happening now in the housing market. You're seeing supply of new houses start to expand and sales start to drop because people just can't afford what's out there. And people who are thinking about selling their house but were on the fence, they're now going to be panic selling pretty soon because they see the market turning. And that's what a couple of percentage points in a major interest rate will do for demand. And let the 10-year Treasury bond yield in the U.S. go up into, say, the 4s from the low 3s, where it has been lately. And you would see all kinds of things just shrivel up out there, all kinds of markets where demand just, goes away if the interest rate is that high. So yes, they can choke off economic growth. But the question is, will they accept the consequences of doing that? And that is the big question going forward. Do they have the cojones to actually bring inflation back down to 2%?
Could the stock markets just be in a correction, or is this a real bear market?
Well, there are two ways of looking at this. One is that it's just another taper tantrum like we saw in 2018 when the Fed raised interest rates and stocks tanked, and then the Fed took it all back and started cutting. Or in early 2020 when the pandemic scared everybody and stocks tanked, but then the Fed eased and everything came back. Is this that again? Or is the fact that inflation is so high right now the wild card in all of this? If the Fed is forced to raise interest rates and otherwise tighten monetary policy sufficient to choke off inflation, and they don't know what the numbers are for that. They don't know how high rates have to go. They don't know how dramatic quantitative tightening has to be in order to bring that about. And they're doing that, in the face of stocks already tanking. Who knows what happens then? I mean, we could see a much, much bigger drop in stock prices. Stocks are already still overvalued, so they could drop quite a ways from here and just be fairly valued. So we could easily see that. A lot of it depends on the Fed. Are they going to behave like they did? In other words, panic as soon as they see the stocks drop and change their monetary policy back to easy? Or are they so constrained right now that they're going to have to let stocks tank as just a byproduct of this thing they have to do that's more important than stock prices? Very interesting situation.
Cryptos are getting crunched. What happened?
Well, one thing general, one thing specific. Cryptos are, especially Bitcoin, are treated by the marketplace like a tech stock. In other words, it's a risk-on asset. If you're excited about what's happening in the world, you buy Bitcoin. In addition to buying Apple and Facebook and Amazon, because you put those things in the same category as things that do well in a happy world, as opposed to gold, which tends to be a safe haven asset. People buy that when they're worried, but they buy Bitcoin when they're excited, and nobody's excited anymore. Everybody's terrified. So you're seeing tech stocks tank, and Bitcoin and most of the other cryptos are just following along. They're just moving with their general asset class. Now, that's the general thing. The specific thing is that there are lots of related assets out there to Bitcoin, and one category is called a stablecoin. That is a cryptocurrency that is linked to some real-world asset, so that according to the algorithm that governs the crypto, the stablecoin, that coin is always worth a certain amount in terms of that other asset. And there's a big one that's connected to the U.S. dollar. And the guys managing that stablecoin bought a lot of Bitcoin to back up their promise that their stablecoin would always be worth $1 US. And then there was a run on that stablecoin. Its value, people started selling it, and its value started to fall. And so they had to dump a lot of their Bitcoin in order to buy back their stablecoin in the open market, and that smacked Bitcoin. So that accounts for a part of the drop in Bitcoin recently. In other words, trouble elsewhere in the crypto universe came back to bite the main crypto asset. And you know what? There's a ton of stable coins and other things that you might put in the same category as stable coins. In other words, cryptocurrencies, things based on blockchains that may or may not be as stable as the managers claim they are. And if this one didn't work, maybe these other ones don't work. And so it's completely possible that the peripheral assets in the crypto space are going to blow up in this bear market, and that's going to affect the main crypto assets like Bitcoin and Ethereum. No way to know for sure, but so far that's the way it's playing out.
Gold, silver miners, and tech stocks are both down hard. Is this a replay of 2008, 2018, and March 2020?
Yeah, so far it is. And it's interesting that mining stocks and precious metals get sucked down along with these other assets that they're supposed to be negatively correlated with. In other words, if stocks tank, in theory, some of the money that comes out of the stock market goes into gold because that's a safe haven asset, and gold tends to do well relative to stocks. But that's not the way it works in the really sharp part of market declines. When stocks tank, they take gold and silver down with them, and the mining stocks get crushed. So we're seeing an exact replay of that process lately. This is 2008 again, it's 2018 again, it's 2020, all over again, as far as the relationship between the mining stocks and the blue chip non-mining equities out there. Now, in each of those previous cases, like I said, the Fed has panicked, gone back to easy, and gold and silver have rocketed from there. And if you bought the mining stocks at the bottom of that process, you made 5 times your money in almost anything and 10 or 20 times your money in a bunch of things. So if this is that again, and you've got some cash, there's a really interesting gut check coming up. Are you brave enough to buy some good quality mining stocks after they've been whacked like this, when the whole world thinks they're going to be sold down to zero? And so I think that that point is coming, but we just don't know where it is. We don't know the point at which we should mortgage our house and buy mining stocks. But I think that that is certainly coming at some point.
Food and energy are looking at major shortages in the year ahead. Is there a solution? And if not, what's the impact?
Well, there is no real solution to food and energy shortages. They just have to run their course. I mean, eventually high prices are the cure for low prices and vice versa. So if you have high prices, they will eventually choke off demand enough that you get low prices. But in this case, there's the geopolitical side, which I think is a total wild card because it's completely unrelated to monetary policy. But, if you're in the developing world, Thailand, Brazil, Mexico, name 85 other countries, and you basically got the same situation. The majority of the population is just making ends meet. And if you raise the price of food and the price of gasoline at the same time, you put these people in a position where they have a choice of making rent this month or feeding their kids. And people in that situation become very unstable, very unpredictable. You get massive civil unrest, which leads to regime change. And a lot of these countries are exporters of agricultural and industrial commodities and energy. So you let them descend into chaos, and all of a sudden that's another kink in the supply chain. So even if things are getting better in some ways, they're going to be messed up by these other things that happen. And that's a very real possibility in the year ahead. Look for some massive civil unrest that leads to regime change in a lot of these countries, which then takes them offline for a while in whatever it is they're exporting. So we're by no means out of the woods yet with this stuff, and we could just move into a new phase of it next year with really the central banks of the world being completely unable to do anything about it.
Yeah, one of those countries could be Indonesia, which just banned the export of palm oil. And palm oil, when you read the ingredients, is in just about anything that has oils.
Yes.
Yeah.
It's a very big commodity that goes into any kind of processed food, among many other things. And a lot of that has just been taken off the market by one country, Indonesia. This might be the only time we talk about Indonesia in the next 5 years of doing these interviews. But suddenly, they are a major factor in the global economy. Now, multiply that by 50 other industrial commodities in the next couple of years, and you get a sense of what the world is going to be like and how messy things are going to be like, and how globalism will be brought into disrepute by all of these supply chains breaking down, and every major country in the world going, wow, why the hell don't we make our own palm oil or some other thing that we can use instead? Why aren't we making our basic pharmaceutical components instead of having to go to China to buy stuff like that when we're fighting with China and every other? That's going to be the debate. And you're going to see a lot of politicians win elections on platforms of nationalism, basically. In other words, bringing back manufacturing capacity to either that country or to at least the region of friendly countries, so that they aren't dependent on something from the other side of the world going right when it may not go right. Lots of things are going to change. And you can trace it all back to stupid monetary policy, but you cannot fix it with any kind of monetary policy going forward.
I believe it was you who wrote that the slowdown in China's economy isn't all COVID related. There's a lot more to it.
Oh, yeah. Well, China basically engineered the biggest credit bubble in human history post-Great Recession. They quintupled their national debt, and they used it to among many other things, create the biggest real estate bubble that anybody's ever seen. Something like 70% of Chinese household debt is now wrapped up in real estate, and the real estate market is tanking. Prices have gotten way out of hand, and the leverage that the building companies were using has become so extreme that they're starting to blow up. So, take COVID completely out of the picture. Say it never happened. China would still have a financial crisis right now because of their over leveraging of themselves over the past decade. Now throw a pandemic into the mix and then throw geopolitical turmoil into that mix, and you get a real mess. And it's not clear that the communist dictators in charge of China have the slightest idea how to manage a fast-changing financial crisis, because all they know how to do is issue orders from the top down, and that's not how capitalist systems fix themselves. They fix themselves via millions of participants committing their own capital to what they see as a fix for the immediate problems in front of them, and things work themselves out. It's messy, but it works. The dictators that try to manage stuff like that from above fail. The Soviet Union failed. Japan, to an extent, Japan was going to take over the world with a top-down financial system and economic system in the 1990s. Now they're almost an afterthought. They have not been a major financial power since that time because they're still licking their wounds from the crisis that they engendered. China's in much worse shape than Japan was. So, wherever you look, there's a story like that. So it's not just the U.S., although we're probably the worst of everybody, but everybody else is making similar stupid mistakes too.
Demand for adjustable rate mortgages is surging in the U.S. Your thoughts on that?
Well, the housing industry in the U.S. got way out of control. It was almost a 2006, 2007 level bubble, but not quite. But it was still a bubble. Now, home prices are unaffordable, as I said, and one of the ways people are responding to that is instead of taking out a 30-year mortgage at 4.5%, they're seeing if they can get an adjustable rate mortgage that for 5 years is 2 or 3%. Now, in an environment of falling interest rates, that's arguably a reasonable risk to take. But in an environment of high inflation and rising interest rates, that's incredibly dangerous. You have no idea what interest rates are going to be 5 years from now. They could legitimately be double digits across the board, and your mortgage could go from a couple of percentage points to 8 or 9%, and you're bankrupt or you're in foreclosure or whatever. And so that's the risk that a lot of people are taking on by using adjustable rate mortgages, when legitimately what they really should do is just not buy that house. In a world like this, renting an apartment for 5 years is the financially smartest thing you can do. Or renting a house, just pay up to rent a house, with the understanding that the minimization of risk makes it all worthwhile. Even if your rent is higher than your mortgage might have been for a few years, you're not going to go bankrupt by renting. So I would totally recommend that most people be renting right now, with the idea of buying their dream house 3 or 4 years from now when everything hits rock bottom and everybody tells you should never buy a house because they always go down. Then step in and make a lowball offer on a nice house. Don't do that now, though.
Unionization is back, with Amazon, Starbucks, and Target employees, among many others, organizing. Could there be huge implications for corporate profits and stock prices?
Huge implications. To kind of set the stage for this, for the past 30 or so years, corporations via globalization have been accumulating more and more of national wealth at the expense of workers. In other words, the amount of wealth in the hands of corporations and the people who own those corporations has expanded like crazy, while workers have seen their wages actually decline in real terms. So the 99% have gotten poorer and poorer in relative terms, and the 1% have gotten insanely rich. That can't go on forever, and now we're seeing the pendulum swing back with there's a shortage of workers out there, and workers now realize that they have power again. And what workers do when they have power is they organize. They form unions, and they demand higher pay, better treatment, et cetera, et cetera. All the stuff we want in a job, they start demanding it. And you're seeing Starbucks unionize, and Amazon, and now Target stores are starting to unionize. And what this will do is, and by the way, it's a good thing from a moral standpoint. People have gotten really screwed over by corporations moving factories overseas and paying people $1 an hour and laying off all their unionized workforce, and then cutting their CEO a gigantic year-end bonus for being efficient. It's been a terrible system for most of the people in the country. And now they're starting to get back what was stolen from them, so it's a very good thing. However, for corporate profits, it's not such a good thing, because if your labor costs go way up and you can't really raise prices very aggressively because you'll chase your customers away, you got to eat the losses. So corporate profits will go down. Stock prices, which key off of corporate profits, will tend to be lower than they otherwise would, and the billionaires and multimillionaires who own all those equities will be much less rich. They'll still be rich, but they'll be a lot less rich than they were. So, it's a really good trend if you can wrap your mind around a world in which stock prices are going down, but the country is getting healthier. That's what we're liable to see. And on balance, it's a very good thing, I think.
Kathy Wood's ARC Innovation Fund continues to collapse. What's the deal there?
Well, she's an interesting story, and I don't want to single her out, except that she represents something that is a recurring theme of bubble economies. In every big financial bubble, there's a handful of money managers who ride that bubble. They bet on the bubble assets and make insane amounts of money during the upward sloping part of that process. And they become kind of household names, and everybody interviews them, and everybody starts to follow what they do and try to emulate their strategies and stuff like that. And really all they did was just buy a bunch of bubble assets, bet the farm on that, that trend maintaining for a while, and do great for a while. Now, Kathy Wood is the most visible person who opted for that strategy this time around, by buying things she calls disruptors. Companies, the stocks of companies that are radically changing established industries. And she made a fortune doing that for 4 or 5 years. She just blew away the S&P 500 with all of her funds. But then everything peaked, the bubble has started to burst, and those companies, because they tend to be kind of early stage, they're not profitable. And because of that, there's no real way to calculate their intrinsic value. So as soon as you get pessimistic, you sell stuff like that. And so that's what everybody's doing. They're dumping the stocks that she owns, and she's still in there doubling down on a lot of her assets. So now her flagship fund has round-tripped. It went from parity with the S&P 500 a few years ago to some multiple of the S&P 500 all the way back down to parity. So if you invested with her, you made no money if you stayed the course the whole way. Now, people like that tend to kind of just fade into obscurity when their bubble bursts. So we'll see what happens with her, but that's the way it's been. You can go back to each of the previous few bubbles, and you'll find these big names who were big names at the time and were thought of in terms of like, hey, is that guy going to run for president? Wow, I wish I'd invested with him and just never taken my money away. You haven't heard of those people, probably, but they were household names back then. They were front page news, and she's a pretty good example of that. And I think, it's a lesson we should all learn. The guy who has made insane amounts of money in a bubble market and is continuing to use that same strategy going forward is somebody you bet against, not with.
Are there any real safe havens right now?
Well, I would normally say, yeah, gold and silver are the main safe havens, but and then well-chosen real estate, but not necessarily. In this kind of a market, this might be one of those things where liquidity just dries up, and you have to cash out with whatever you can sell in order to cover the debts that you took on in order to create your ridiculously aggressive portfolio. And maybe you got to sell your gold and silver too. Maybe you got to sell that rental house that you bought a couple of years back. Maybe you have to sell your vacation house. Maybe you got to sell your Exxon stock, even though it's done so well lately. So pretty much everything tends to get whacked in times like this. There are a handful of defensive stocks like grocery store chains and things like that, and electric utilities that tend to do okay. But even if you've got a grocery store chain and it hasn't gone down yet and your tech stocks are down by 40% and you're getting margin calls from your broker, maybe you sell that grocery store chain too. So, cash is probably the only thing you can be in at times like this that holds its value in relative terms. But even cash, dollar cash is down by 10% this year in terms of real purchasing power. So even that's not a safe haven. Now, having said all that, gold and silver are probably still the best, even though they tend to get whacked in times like this. Gold is better than silver on the downward sloping part of this. But you should take heart from the fact that there's a bottom to this process. And that bottom is when the Fed says, okay, I think we're going to stop raising interest rates now. And a month later says, okay, we're going to stop QT and we're going to go back to QE. Things like that will happen. And then gold and silver will just rocket. So that's where you want to be at the bottom of this whole thing. And yes, you can probably buy some tech stocks and do okay too, but I suspect they'll still be overvalued relative to the good mining stocks and actual gold and silver. So, I plan to focus mostly on the highest quality miners when they get knocked down, as they are today again. And just load up on those with the idea of, making 5 or so times my money if I call the bottom right with these things, before cashing out.
Could electric vehicle battery metal shortages continue for a while?
Yeah, see, that's something that's really unrelated to anything else that's going on, because we are making the shift to electrification. In other words, most of what we have is going to be battery powered instead of gasoline powered going forward. And that requires a huge amount of the stuff that goes into the batteries, the wires that run from the battery to the motor, and all kinds of other things. So a world of electric cars, electric leaf blowers, electric chainsaws, and electric everything else you can think of will require incredible amounts of lithium and nickel and cobalt and copper and silver. And, even in good times, if we were not over indebted and we weren't on the verge of a nuclear war and yada yada, we didn't have political chaos everywhere you look, you would still see battery metals and related things being in shortage and therefore being more and more expensive over time, just because there's not enough of this stuff in terms of current mine output to satisfy, say, 5 years ahead demand. In other words, the number of electric cars we intend to have in 5 years and the number of solar panels on roofs we intend to have in 5 years outstrips the amount of material that they will require that is now coming out of today's mines. So we're going to have to open new mines, for instance, copper mines. And in order to make those mines economic, because they'd be running today if they were economic at today's prices. And the fact that they're not implies that you need a higher price. So the price of those metals has to go up in order to generate the new supply necessary for us to fulfill our plans. So, I think especially to the extent that those things are getting whacked right now along with everything else, it's an interesting, that's not a safe haven play as much as it is a growth industry play. So pick the very high quality players in that space, and you've got the financial wind at your back for maybe 20 or 30 more years, unless some new technology comes along that makes copper obsolete. But barring that, and barring a nuclear war, barring those two things, it's highly likely that it'll be a good environment for those kinds of commodities for a long, long time.
Could the planned wiping out of wealth in the various markets be part of the push towards Agenda 2030, the Great Reset, where you'll own nothing and be happy about it?
Well, there is a body of thought out there that says that all of this crazy stuff that's happening isn't the result of the utter stupidity of the people in charge. They're actually kind of smart, and they're actually pursuing a plan that is just not so obvious to us right now. And each crisis, for instance, makes us a little bit more and more malleable. We were still pretty feisty in 2000 when tech stocks collapsed, but we were a little easier to manage when the housing bubble burst. And by the time the pandemic came along, we were apparently very easy to push around. So let's have this next crisis come along, say the stock market tanks and yada yada. You get the whole financial crisis thing that is at least possible in the next year. Then it's going to be relatively easy to declare martial law, to take away our civil liberties and start imposing all kinds of things on us because we're so used to being bossed around. And if that's the plan, it's working out pretty well for the guys in charge because they're, step by step turning us into sheep. And if next year is the year that they decide to fleece us, to pen us up and fleece us, that, it wouldn't be that big of a surprise. I don't necessarily think that's true. That it's all happening that way. I still think it's completely possible that these guys are just complete morons. But if they're evil geniuses, then you have to admire the audacity and the execution that they've shown so far. And we'll find out soon enough which it is.
Could the ongoing court-ordered Pfizer document release be bearish for the pharma sector?
God, you have to hope so. I mean, that is just horrendous. Apparently, to give a little background here, Pfizer did a lot of testing for their vaccine that they brought to market in like 2 weeks, the record time. And there was a lot of data generated and everything. And they decided they didn't want anybody to see the data. So people did FOIA applications, Freedom of Information Act applications, and used other legal means to finally get a hold of some of that data. And apparently it shows that they cut corners on a scale that ought to send the people involved to prison and ought to result in the government clawing back most of the money that it gave these guys for their vaccines. Now, we'll see how that goes. I mean, everybody in sight is on the payroll of Pfizer, right? We know that. So it's going to be kind of hard for these guys who are basically Pfizer employees to do anything about this, but based on the information that's coming to light, oh my God, you would think they would just break up the big pharma companies, that you would go in and you would apply antitrust to those guys. They would fire the top echelon of every one of these companies and then break up the assets into 100 smaller companies with very, very strict conflict of interest regulation. I don't think that'll happen, but that's what should happen.
Do you think the Russia-Ukraine conflict is responsible for turmoil in the markets, or is it just being used as an excuse?
I think it's responsible for objective turmoil. That the fact that Russia and Ukraine are both being sanctioned, Ukraine is being hamstrung by the fighting on their soil, and Russia is being sanctioned in ways that keep a lot of the stuff they normally sell from being sold. However, I think you could make the case that this does kind of look like a plan on the part of NATO to push Russia into a debilitating quagmire and weaken them. Okay, because nobody cares about Ukraine. I mean, the Ukrainian people are wonderful people, and it's horrible that they're suffering the way they are. But nobody in the U.S. cares about the rest of the world. There are wars everywhere. Do you think anybody in the U.S. cares about Saudi Arabia killing 1 million Yemenis? Or, what's happening in Israel and with the Palestinians, or what China is doing with the Uyghur Muslims over there? Nobody pays any attention to that. But the guys in charge of the U.S. have decided that Russia is the boogeyman, and we're going to use Russia as the excuse for all the stupid mistakes we make domestically. So they are, they're expanding NATO right up to the Russian border, even though Russia has said, you can't do that. That's a red line. That's an act of war. Stop that. That Russia's been saying that they were going to go to war over this, and they have forced Russia into it. That's a point of view. I kind of subscribe to that point of view, but I understand there's a lot of disagreement about this, but that's what it looks like to me. And because of that, you could say that Russia is being used to cover up a lot of malfeasance and incompetence that they'd rather us not see, and that they're risking a global nuclear war for this is just astounding. I mean, there are literally people in the U.S. government and definitely in the U.S. media who want us to start a shooting war with Russia over Ukraine that might involve nuclear weapons, and they seem really blasé about it. We've got more missiles than they do. You actually hear people saying stuff like that here. It's terrifying. A big financial crisis like you and I usually talk about is a totally survivable thing. We can get through that. We might even get richer during that. But a nuclear war is off the charts scarier than a giant global financial crisis, and that's the risk that we're taking, as if we don't have a lot of other things to worry about, which we do, and that just terrifies me. I hope we get through this. If we do, let finance do whatever it does. Let's just get us through this nuclear risk situation here and put that one to bed.
Mm-hmm. What sectors are you currently investing in?
Well, I'm one of those don't do this at home, don't try this at home kind of investors, where you should never, ever look at what I'm doing and think, oh, let me try that. That sounds like a good idea. Because I tend to get an idea in my head and then just jump into it with both feet. So I bet the farm over and over again on big ideas. And right now, the big idea is that the market's overall is going to tank, and gold and silver will be the big winners with the mining stocks a few years from now. So I've got a lot of mining stocks, which are getting whacked right now, but I've got, enough cash to grab a bunch at the bottom. And I've got a lot of short positions on the NASDAQ and the S&P 500 and a few stocks like Tesla and some home builders. And they're working out nicely lately. So I'm kind of hedged against the miners tanking. And I'm wondering now where to cash out the short stuff and when to roll the proceeds into beaten down miners. So the coming year will kind of be that process for me. With any luck, the stock market will tank some more from here. I'll close out those shorts and then throw that cash at some beaten down miners. So we can talk about that if you want to each month, and I'll give you a progress report.
John, before we go, can you tell us a little bit about your website, dollarcollapse.com?
Well, it's no longer my website. I founded it back in 2004 and recently sold it to some very good managers. So it's already improving from what I was doing with it. And it's basically the same website with the same premise. The world is destroying its big fiat currencies, and what can you do to invest to protect yourself? So, go there, join the mailing list. You'll get a lot of stuff from the new manager, David Haggith, who's a very good writer, and he's really plugged into this stuff. And he'll send you whatever he writes on a daily basis.
John, thank you so much for being on This Week in Money.
Thanks, Jim.
My guest has been John Rubino, author of several books on the economy, including The Money Bubble. Coming up, Steve Saretsky, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Steve Saretsky. He's a Vancouver-based realtor, online at stevesaretsky.com. Welcome back to This Week in Money, Steve.
Thanks for having me on.
Is the latest issue of the Saretsky report out?
Yeah, I just published it a couple days ago, so you can go check that out on our site, stevesaretsky.com.
And Steve, what's the big line in the report this time?
Just changing of the guard. I think I think everyone's well aware the housing market's, underway. A correction is underway. We've kind of begun that. Now we'll kind of look forward to seeing, how long it lasts and really, the depths of any sort of price declines. And I'm sure we'll sort of unpack that a little bit further in the interview here. Inflation's
the big story. What do you think is the real rate of inflation, and what needs to be done to get it under control?
Well, I think everybody knows that it's been, widely underreported for years, right? I think that, everyone has a different rate of inflation, right? I always think like if you're in, we've got a national home price index, a national inflation basket, but if you're in rural Saskatchewan, you probably have a different rate of inflation than somebody that's in, a millennial in greater Toronto area, So I think that, the rate of inflation is probably been in the double digits here. Obviously we still have like a 30-year high, even per their own official metrics. So you've got the Bank of Canada obviously coming out and acting tough on inflation and saying they're going to raise rates to, however much it takes to kind of quell inflation. But I think ultimately it's pretty tough to be Paul Volcker 2.0 when you have, debt to GDP in Canada, household debt to GDP, I think it's north of 110%. So, and corporate debt, and even that, you've got we really do have a global sovereign debt bubble, right? So, I just don't think there's actually really any ability to combat inflation. And I think a lot of the inflation is on the supply side, right? You've got China still running a COVID zero policy, so those are supply chain issues. Then you've got sort of the re-onshoring of manufacturing. So I just think that, what they're planning to do is basically raise rates, just to shoot inflation in the back of the head, to basically kill demand, right? So they're going to kill demand, but they're not going to be able to really solve the supply side, which is where I think quite a bit of the inflation is coming from. So, even by killing demand, you might still end up with inflation running at 3%, 4%, 5%.
Mm-hmm. Well, yes, I watched the Fed presentation last week. They said we can't do anything about supply. We don't make grain. We don't supply oil. We can quell demand. And is this sometimes a case of the cure is worse than the disease when you have interest rates like they did back in the late 70s, early 80s go up to 19, 20% in some cases?
Yeah, I just think like you really can't get there without having like a financial crisis. There's just too much debt, so you can raise interest rates, which again they're going to do. And I just think like all you have to like look around. It's pretty obvious things are already starting to break. There's been year to date we've actually got $35 trillion of wealth has basically evaporated. So you can see the losses obviously happening so far in big tech. Some really great companies down 75, 80%. We've seen a lot of turmoil in the crypto market, and now we're seeing, which is the lagging indicator, an abrupt slowdown in housing. So, they're eroding and evaporating wealth, and I think they're ultimately trying to do that, to sort of, they're calling it the reverse wealth effect, right? So, the playbook is obvious. It's like, well, how far are you going to get before you basically trigger a financial crisis? And I think like we can clearly see, we've only raised rates here. The Fed's only raised rates, 50 basis points, and already, all hell is kind of breaking loose as is.
Sure, the Bank of Canada raised the rate half a point for the first time in over 20 years. Do you think they'll be forced to make further interest rate hikes due to high inflation?
Well, yeah, I think we're going to get 50 basis points in June. It's already kind of baked into the cake, so I don't see any change happening there. But like I said, I think housing, which is really, I think, probably the most important economic metric in Canada, is abruptly slowing. And I think it's slowing a lot more than policymakers are probably aware of. And so, it just comes down to, like, at some point you're going to reach a level of, like, inflation versus financial stability, right? I mean, I know everybody, there's a lot of people out there rooting for, house price corrections, but that's not really how central bankers think, right? I mean, like, if you have a 20% fall, like, say, nationally in home prices, then you start talking about financial stability, right? You start talking about banks' inability to loan, that, basically an erosion of the bank's capital base, right? So, and you start talking about financial stability. So that's ultimately just kind of, it is what it is. So that's the kind of things that we're looking for moving forward.
We're hearing interest rate hikes could continue into early 2023. What are you hearing?
Yeah, well, I mean, that's kind of like, forward rates are obviously suggesting that's what markets are kind of pricing in. But, I mean, a lot of it is markets typically move central bankers, right? They're kind of doing the central bank's job. And so, I mean, historically, if you look at it, like, these basically forward rate predictions are always end up being wrong, right? They end up having to reverse once things start to break in financial markets. So that's kind of what I think is the next step is, stocks probably keep selling off here, down 17% year to date in the S&P. It does reach a level where they'll probably start pricing in fewer and fewer rate hikes and then ultimately rate cuts, which they've already sort of priced out into 2024. But I see that probably moving up further into 23.
Are the Bank of Canada and the Fed between a rock and a hard place when it comes to interest rates in real estate?
Well, yeah, probably more so in Canada than in the U.S. Obviously, we've got rate sensitivity in Canada because every 5 years your mortgage renews at the prevailing rates, right? So you don't have the ability to lock in a 30-year term in the U.S. And also that we didn't deleverage in 2008, 2009 like the U.S. did. So we're much more rate sensitive in Canada than the U.S. is. Ultimately, we will take our policy guidance from the Fed. So that's the Fed is really the central bank that ultimately matters. And obviously they've got an aggressive rate hiking trajectory moving forward. But again, we're already starting to see that sort of reverberate across financial markets, which is the U.S. dollar continues to strengthen, and that is creating a lot of distress in various parts of the market, like we talked about earlier. You're seeing that in tech, you're seeing that in crypto, and we're seeing that just across the broader market as well. And there is a slowdown that's underway in U.S. housing.
What's happening in the Metro Vancouver housing market in the high-end, mid-range, low-end, detached, and condos?
I mean, I think as a general rule, I would say, like, most of the market is undergoing a correction. Most of the correction is underway is actually in the suburban markets. Where we're seeing, I guess, some strength is at the entry-level points, particularly in the city of Vancouver. So, if you're looking for a one-bedroom condo, $600,000, $650,000, which is really like your floor. That's your floor price. That's almost basically as cheap as it gets. There's a lot of demand in that segment, right? Because you have these first-time home buyers that are trying to squeeze into the market, get on the housing ladder. You got a lot of investors that are, trying to buy these sort of smaller, cheaper one-beds that they can rent out, for better yield. So there's always a ton of competition in that segment. So we're still seeing a lot of strength in that market. We're actually still seeing multiple offers. And I think that market, particularly in the city of Vancouver during the pandemic, didn't have a huge lift like everywhere else did. And then where you're seeing most of the correction is like where a lot of the froth was, which was that, detached house, those townhouses, particularly in the suburbs that, I mean, realistically, they basically doubled in price over the last 3.5 years. So they're undercoming 10% to 15% corrections right now. So it is quite noticeable, but I mean, that's from peak valuations back in February. So I think that's, and keep in mind, like, I always look at it and say, well, where's the rate sensitivity? I mean, let's be honest. If someone's buying a $5 million house on Vancouver's west side, they don't really care if the mortgage rate goes from 2.5% to 4%. Like, most of them are coming in with huge cash down payments. They're business owners. They got a lot of income, a lot of equity. They're not really rate sensitive. Where you see the rate sensitivity is in really like, well, where's the blue collar working class? When the mortgage rate goes from 2.5 to 4 on that $1 million townhouse out in the suburbs, and the payment increases by, $400 or $500 a month, that starts to really chip away, right? And so, the $400 to $500 increase in the monthly payment, you tack on the rising cost of fuel, food prices. I mean, that's really where the squeeze is, and I think that's probably where the most vulnerability is in the housing market.
How are buyers and sellers reacting to lower sales and lower prices?
I think it's as every housing correction, when prices start to come off, buyers lose the sense of urgency, and they all sort of want to wait. Oh, let's wait. There's just not a sense of urgency. You do have a few people out there today that are trying to get in before their mortgage rate hold expires. But in general, I think we're in a situation where a lot of buyers are kind of in wait-and-see mode. They might be actively looking. Some are throwing in some low-ball offers. I mean, we're not really quite at the point where we still have a very low inventory base. So it's like, just because the market's changed over the last 2 months doesn't mean some sellers just going to start accepting low-ball offers. We're not really seeing that. But yeah, buyers, I think, are definitely taking the time.
In Vancouver, the benchmark home price in 2000 was $342,000. In 2022, the benchmark is close to $2.1 million. For 22 years, the compounded rate of return has been about 9%. Could this be a yin and yang indicator of what may lie ahead?
Yeah, I think that $2 million would be for clarification, I believe that would be for detached house prices. I think what's important to sort of contextualize there is that everyone goes, wow, $2 million for a house in Vancouver, that's insane, must be a bubble. I think what's important to also understand is that while those valuations are certainly stretched, I don't disagree there. I think that every single year, if you look at the stock of single-family houses, that's contracting on an annual basis. We're not building single-family homes anywhere in the Lower Mainland because there's not really any land to put them. These single-family houses, in fact, are being rounded up into land assemblies and being repurposed and rebuilt into townhouses and condo buildings. So I think that's important to understand is that, as the population continues to grow every single year and you get more capital coming into this market every single year and you see the number of single-family homes contracting every single year, that you start to realize, even the head of OSFI calls it, the Manhattanization of really Vancouver and Toronto, which is they're going to go up. They're building up. They're not building out. And so I think that, at least for the single-family segment, I think that's a longer-term bullish outlook for that market. Now, can there be corrections over the next 12 to 18 months? Yeah, I think there will be, and we already are seeing it. But I think from a bigger picture, that kind of helps contextualize that $2 million benchmark, because I think it ultimately is. It's a luxury product, and it will continue to be a luxury product.
If this is the big real estate crash that Vancouver hasn't experienced since the early 80s, how long would it take for prices to really start dropping?
I don't really have any strong opinions on that. I mean, like I said, I think we're going to undergo a correction here. I mean, corrections tend to be in the housing market tend to be long and drawn out. I mean, if you want context for the U.S., right, house prices peaked in 2006 and they bottomed in 2012. So do I think we're going to that sort of dynamic that this is, U.S. housing crisis bubble 2.0? I don't think so. That's certainly not my base case. But I mean, I know there's people sort of salivating at the fact that they might be able to buy a house for 70% off, and I just don't see it. But yeah, I do think it just depends on really the interest rate trajectory, right? I mean, I think central banks, yes, they're somewhat trapped. It's going to come down to inflation, central bank policy. So much of this is unpredictable. Even the central bankers have no idea what they're doing right now. It's all trial and error. So a lot of the sort of path forward, I think, for housing is going to depend on that. So,
and of course, BC's unique amongst all the Canadian provinces in that 100,000 people moved in last year, and there's no indication, is there, that that's going to change? 100,000 more people a year?
I mean, the last time I looked, the Trudeau government is ramping up immigration. So, I mean, they're obviously coming out and talking about housing affordability, and we care, and we're trying, and, meanwhile, they're ramping up immigration. So, I don't know where we're going to house these people. So, I think underlying all of this, that, interest rates are going to put a damper on housing. Liquidity drives housing market, and liquidity is drying up. But yeah, I mean, at the end of the day, bigger picture, I mean, there are still a lot of underlying fundamentals of the housing market here that people are continuing to plow into BC. And so that's, again, I think bigger picture is kind of where things are at. I mean, we're still an undersupplied housing market.
Governments, when they talk about affordability, quite often say we're going to bring in rent controls. But if you do that, doesn't that discourage the building of rental accommodation, which would make the squeeze even worse?
Yeah, I think so. I mean, we're already starting to see some developers, pausing projects, just because a lot of that actually is coming down to financing rates, makes these projects somewhat unfeasible. So we will see a slowdown in new housing supply. And again, the same thing as the housing market slows, and as developers see the outlook for housing, and they will slow new housing supply. They will slow. Like if you're a developer and you see, the rates are going up, the central bank says they're going to keep raising rates, they basically want to slow housing. Why would I launch a new product? Like, why would I spend all this money, run all this risk to maybe not sell the product? So that's where we're going to start to see new housing supply really start to dry up. So I think again, longer term, you'll probably see some supply crunches again down the road. So I mean, these are all things that we're kind of weighing and looking at, and it's definitely a tougher picture to sort of analyze. Mm-hmm.
And I've also heard too that the cost of building has gone up dramatically. Steel costs more, aluminum costs more, paint, if you can find it, costs a lot more. Lumber, again, has spiked in price. It's not cheap to build, let alone the cost of the land.
Yeah, so, I mean, just to kind of put this in context for people that might not be aware, I mean, if you, I always make the joke of okay, I'm going to, we've got a housing affordability problem, so let's run a fun analysis. I'm going to give you a piece of dirt in East Vancouver, which would normally cost you 1.7 for the dirt. I'll give it to you for free. You just got to build a house on it. Well, to build a house in East Vancouver, a modest house, I'm not talking super high-end appliances, but just sort of a normal 2,500 square foot house, it's going to cost you $1 million. That's for labor and construction and material. So, I don't know, $1 million is still a lot of money. I don't know if that's necessarily quote unquote affordable housing. And you can apply the same sort of math to, any new developer that's building condos, right? I mean, the cost of building, let's say a high-rise condo in Vancouver is your minimum $600 a square foot. Just to build, let alone what does the land cost? Well, the land costs about $500 a square foot. Now you're at $1,100 a square foot. It doesn't include the developer's profit. It doesn't include his financing costs. It doesn't include his sales and marketing costs. So the developer's break even is probably $1,300 a square. So then he's got to now sell it to make a profit and make it worth his while because he's taken on basically 7 years of risk. He's probably got to sell us for $1,600 to $1,700 a square foot. And that's why you don't see any products launching in downtown Vancouver for less than $1,700 a square foot. That's the new going rate. So even if let's say the land goes from $500 a square foot down to $200 or $250 a square foot, the land price gets cut in half. You have a big, huge real estate crash. Well, I mean, I don't know. It's still going to be extremely expensive to launch a new product because the cost of construction and labor continues to rise. And not only that, but you got government fees on top of that. So, yeah, I think the affordability is questionable. It is what it is.
In the past few real estate downturns in Vancouver, catching a falling knife worked well for people. Are there indicators people should look for before catching a falling knife?
Probably sentiment. I don't know. Sentiment. I think that we can always look at months of inventory. There'll be some signs on the wall, I think. But it's always I think it's extremely hard to pick and time bottoms. I mean, at least on a regular and frequent basis, someone might get lucky once or twice, but to do it frequently, I mean, if it was that easy, everybody would be billionaires. So, I think there's just some things that we can watch. I mean, if I look at it today, months of inventory is actually still really low. The correction is happening right now because sentiment is quite bad. And, so I think there's probably more downside once months of inventory, keeps building here, which is going to take, many months to do. So, but again, a lot of this depends on interest rate trajectory, right? If the bond market starts to reverse in the other direction, which seems like we're having at least temporary stop out in yields here. You know, if mortgage rates go back from 4% today back down to 2.8, all of a sudden I think your housing correction might be over.
What percentage of high-end, mid-range, and low-end homes do you think carry variable rate mortgages versus locked-in mortgages in Metro Vancouver?
Oh yeah, we don't have nobody has the breakdown by segment in terms of, you know, single family, high end, single family, or whatever. It's just, all I can tell you is that typically speaking, I think it's about roughly 65 to 70% of the time, historically, people have gone with fixed rate mortgages. Today, I think over the last 18 to 24 months, I think about 65% of new mortgages have been going variable route. People, again, I think misunderstand variable products. They just assume that every time the Bank of Canada raises rates, that people's payments are going up and there's going to be financial stress. The reality is most Canadian banks that issue variable rate mortgages are fixed payments. So if the Bank of Canada raises rates by 150 basis points, your payment does not change. The only thing that changes is the amount of your payment that goes towards the principal pay down and your interest costs. So I think it's important to keep in mind that the vast majority of variable products in Canada are in fact fixed payment and they're not floating rate.
How has mortgage debt growth been during the pandemic versus prior to the pandemic?
It's running basically at about double the rate it normally has been. Residential mortgage credit growth is at a 14-year high. So Canadians have certainly taken the cues from the Bank of Canada governor there that they should blow their brains out and borrow as much money as they can. And that's what they did. And that's why we had a housing bull market. And that's why I think we ultimately staved off probably what would have been a depression. But, you know, again, banks were lending money and people were borrowing money and that sort of kept the economy going. So, and now obviously they're tasked with draining some of that liquidity. And we're obviously seeing, you know, the outcomes of draining that liquidity already in again, some of these big tech names and in crypto space and whatnot. So.
Is Trudeau's 2022 budget likely to affect real estate?
I don't really think so, to be honest. I think a lot of it is just political grandstanding. For example, I'll give you one example is the foreign buyer ban for 2 years. If you actually read the budget, go through the 200 pages there, most of their housing policies have a specific date and timeline for its implementation. The foreign buyer ban says, quote, we have an intention to propose restrictions. We have an intention to propose restrictions. Well, that doesn't mean anything. What the hell does that mean? There's not even a date for when they intend to propose them. So this is a policy that still has to go through parliament, legislation. It might never see the light of day. So, but again, the media ran with it and it sounded great and I'm sure it's going to get him a bunch of political votes.
Steve, in reality, foreign buyers really haven't been much of a factor, have they, since 2017, have they?
Well, I mean, how they're calculated is also a little bit challenging because I think a lot of like people that think are foreign buyers are ultimately Canadian citizens that maybe work and earn income overseas. If you look at the BC government statistics, 1.2% of transactions in British Columbia last year were purchased by foreign entities, basically, or foreign residents. That would have had to pay the foreign buyer tax. So 1.2% of all transactions in BC last year. So as it is currently sort of done, like I don't see any way around it, right? Like from that angle and that perspective, foreigners are basically like a non-issue. I think the problem lies in that, I know you can call it more so, maybe it's an immigration problem where you have wealthy foreigners that have permanent residency status for Canadian citizenship that are able to buy housing. And there's no way, and there's no policy that I see that is going to change that.
What are developers doing?
I mean, the pre-sale market's still quite strong right now, but I think that we are starting to see it slow down. So we will see developers rein in housing starts. Land acquisition is slowing down as well. So, I think like everybody else, it's kind of somewhat of a wait and see.
Do you think the cryptocurrency markets have an effect on real estate?
I mean, I think it's all relative, right? People say, well, where's the money coming in from Vancouver and Toronto to buy these $2 million houses? Well, the reality is a lot of them are, yes, some of them are high income earners, but a lot of them have built existing assets, right? So, like, I know I can tell you for a fact that I've worked with several millennials this year that have acquired their down payment through cryptocurrency. You know, they bought whatever Bitcoin or Ethereum, 18 months ago and it ripped and they decided to liquidate some of that and use that as a down payment. So and so when that asset class or when the stock market gets cut in half, that ultimately will filter through into housing to some degree.
Are you seeing an increase in estate sales?
Yeah, we're not really seeing a whole lot of estate sales. Nothing out of the normal.
At some point, do you think homes will just be a place to live instead of an investment?
Unless we rework the entire financial system, probably not. I think that, with the introduction of mortgage-backed securities in the 1970s kind of created the financialization of housing. So, plus the removal, I guess, of the gold standard, whatever you want to call it. But yeah, I don't foresee housing being returned back to, a different style of investment.
During tougher real estate markets, what should people be looking for in a realtor, whether they're buying or selling?
I don't know. I'd probably say experience. A lot of the times it's, your experience in negotiating. I think these markets become difficult and more challenging, and this is where, we're going to see a drop-off of inexperienced realtors, people that are doing it part-time, that, anyone can make money in a bull market. And I think that as the market changes, you'll see, the good ones will rise to the top. They'll continue to do well, make money. And the ones that are, I would say, less experienced, don't necessarily know what they're doing, or just haven't built a reputation, or have put their clients' best interests first, will ultimately will struggle.
How can people get in touch with you, and how can they get the latest issue of the Saretsky Report?
SteveSaretsky.com is the website there. The report's there for free. And then the best way to just get in touch with me is always shoot me an email. So it's steve@stevesaretsky.com.
Steve, thank you so much for being on This Week in Money.
Awesome. Thanks for having me on, Jim. Appreciate it.
My guest has been Steve Saretsky. He's a Vancouver-based realtor. As he said, you can find him online at stevesaretsky.com, and he's also on Twitter at Steve Saretsky. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Rubino, and Steve Saretsky, and thank you for listening. If you have any questions for our guests or for the show, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.